SpaceX Q2 2026 earnings special. Revenue reached $7.81 billion, up 92% from a year earlier, in the company's first earnings report as a public company. This is SpaceX Daily, episode 59. SpaceX reported revenue of $7.814 billion for the second quarter, up 92% from $4.071 billion a year ago, and ahead of the roughly $6.9 billion analysts had expected. Net loss narrowed to $541 million from the $1.008 billion loss recorded in the same quarter last year, while loss per share came in at 9 cents against an expected loss of roughly 26 cents. Adjusted EBITDA rose 191% to $3.538 billion, and loss from operations improved to $143 million from $970 million, placing the company close to operating break-even on a quarterly basis. For the first half of the year, the net loss reached $4.817 billion, but that figure includes a $1.545 billion loss on debt extinguishment and a $671 million deemed dividend tied to the pre-IPO capital structure. Those one-time items explain much of the headline's 6-month loss and should be set aside when comparing ongoing performance. In the space segment, revenue reached $962 million, up 29% year over year and 55% sequentially, while operating loss widened to $542 million as Starship research and development spending accelerated to $1.076 billion, 55% higher than a year earlier. The company conducted 38 launches in the quarter, 10 for customers and 28 internal, lifting 485 metric tons to orbit. The operating loss grew because development costs for the next-generation vehicle outpaced launch revenue growth in the period. Connectivity delivered the clearest profit contribution, with revenue of $4.291 billion, up 66% year over year. Operating income of $1.656 billion, up 79%, and adjusted EBITDA of $2.597 billion. Starlink subscribers reached 12.0 million, doubling from a year earlier and adding 1.7 million in the quarter, while average revenue per user held steady at $66 per month after the deliberate reduction from $85 a year ago to expand the addressable market. Consumer revenue grew 44% to $2.485 billion, while enterprise and government revenue more than doubled to $1.806 billion. The AI segment posted revenue of $2.561 billion, up 247% year over year and 213% sequentially, driven by new cloud services agreements that lifted AI solutions and infrastructure revenue to $2.194 billion from $311 million. The AI segment recorded its first positive adjusted EBITDA of $1.146 billion, compared with a negative $276 million a year earlier, even as it posted an operating loss of $1.257 billion because of heavy depreciation and continued research and development outlays. 2 successful Starship V3 flight tests occurred in the quarter, Flight 12 in May and Flight 13 in July, both from the new Starbase pad. Flight 12 achieved the first suborbital mission profile and a precision upper stage landing along with modified V2 Starlink satellite deployment. Flight 13 met all objectives, including deployment of 20 production V3 satellites, an in-space Raptor relight, and the softest Starship splashdown recorded with an intact heat shield. On the earnings call, Musk stated the next flight, tentatively scheduled for the end of August, will attempt to catch the ship with the tower pending regulatory approval and projected a cadence of at least 1 flight a day, possibly more within a year. Cloud services agreements totaling $14.1 billion in contracted sales drove $1.6 billion of incremental AI infrastructure revenue, while nameplate compute capacity expanded to 1.4 gigawatts from 1.0 gigawatts in the prior quarter and 0.4 gigawatts a year earlier as Colossus II construction continued. Reporting on the call noted a Google agreement for AI capacity and that Anthropic contracted all of Colossus I capacity in Memphis. The company announced an agreement to acquire Cursor for $60 billion, expected to close in the third quarter of 2026, to accelerate AI enterprise offerings. Grok 4.5 was released in July as the largest model to date, trained alongside Cursor and incorporating the 1.5 trillion parameter V9 foundation model. More than $6 billion in multi-year U.S. government Starshield contracts were secured, primarily 2 Space Force awards for low Earth orbit communications and sensing. Additional connectivity wins included an American Airlines agreement, plus activations on Southwest, Virgin Atlantic, Iberia, and Aer Lingus, plus mobile partnerships with SoftBank, NTT Docomo, and Spark NZ, and FCC approval of the EchoStar license transfer covering 65 MHz of U.S. spectrum and global mobile satellite service licenses. One thing worth watching is the quarterly capital expenditures that reached $18.369 billion, of which $15.828 billion went to AI infrastructure, roughly 39% above analyst estimates, with management indicating the next 2 quarters could show similar levels. Operating cash flow for the first half totaled $3.466 billion against $28.476 billion of first half capex, so the spending is being funded by the IPO and bond proceeds rather than current operations. After the print, SPCX fell roughly 7% in after-hours trading and hovered near $117. Below the $135 IPO price and the $150 opening trade. The first major share lockup expiration begins August 6th, creating a supply overhang to monitor. 2 customers accounted for approximately 19.5% and 18.3% of second quarter revenue, illustrating concentration risk tied to the new cloud services agreements. Starlink average revenue per user declined from $85 to $66 year over year as part of the scale strategy. The CFO's statement that the company is on a trajectory to reach $100 billion of annualized recurring revenue by year end should be treated as a management projection whose definition and timing carry the usual caveats around backlog conversion and contract ramp. Commentary following the release highlighted the revenue beat and subscriber growth as impressive while focusing on the scale of AI-related capex as the primary driver of the after-hours decline. Outlets such as CNBC noted that soaring AI costs weighed on the stock despite the top-line outperformance, with investors emphasizing near-term cash burn. Commentary from accounts including At Homo Trades described the revenue trajectory as strong yet flagged the capex debate as the dominant concern. Other posts observed that NVIDIA remains positioned as a direct beneficiary of the infrastructure build-out. The sharpest takes centered on whether the AI revenue quality and long-term utilization justify the quarterly spend rate rather than on the launch or Starlink results themselves. From an engineering standpoint, the $15.828 billion in quarterly AI infrastructure capex appears on the balance sheet as servers and networking equipment rising from $22.7 billion to $34.8 billion in 6 months, and construction in progress nearly tripling to $12.6 billion, while nameplate compute capacity scaled from 0.4 gigawatts to 1.4 gigawatts in a single year. A gigawatt-class data center draws continuous power on the order of a large city, whereas a single Starship launch consumes energy measured in minutes. The depreciation line in the AI segment reached $1.885 billion per quarter because chips lose value on a schedule measured in years rather than the flight-proven reusability of rocket engines. Connectivity operating leverage stems from the fact that 28 of the 38 second quarter launches were internal Falcon flights carrying Starlink satellites at marginal cost once the vehicle and pad are already operating. The same first principles approach that drove Raptor engine cost reduction is now being applied to data center power density and networking, with the vertical integration of launch, satellite production, and compute hardware intended to compress the cost curve across both orbital and terrestrial infrastructure. SpaceX traded near $117 in the sessions after the release, below the IPO reference levels. Forward items include the Flight 14 tower catch attempt window at the end of August, the Cursor acquisition close expected in the third quarter, the next 2 quarters of elevated CapEx, the ongoing lockup expiration calendar, and the trajectories for Starlink subscriber additions and compute capacity expansion toward the stated 2 gigawatt target by year end. The quarter showed a launch cadence supporting internal Starlink deployment, a connectivity business generating operating income, and an AI segment achieving its first positive adjusted EBITDA on the back of large contracted agreements. The same period also revealed quarterly AI CapEx running well ahead of operating cash flow and customer concentration in the new revenue streams. The open question left by the filing is whether the infrastructure build rate and the Starship flight cadence can both scale fast enough to convert the backlog and contracted compute into sustained cash generation. And that's a wrap on today's SpaceX developments. SpaceX is trading at $115.80, down 0.1%. Share this with a fellow spaceflight fan if you found it useful, and subscribe so you don't miss tomorrow's episode. I'm Patrick in Vancouver. See you next time. Quick tip from the network. Try models and agents for beginners next. Artificial intelligence explained simply for beginners and curious teens. Every Nera Network show is free at neranetwork.com. And on the website, every episode's visuals live in our free image gallery at neranetwork.com gallery. Royalty-free under Creative Commons. Download with attribution. This episode used AI voice synthesis of my voice. Editorial selection and analysis are my own.